Hello and welcome to the Harwood Report for June 4th, 2018. I am Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. As always, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. This week's highlights are going to be running through the normal macro indices here. I really want to focus on what's going on in the equity markets because it's getting more exciting. Bonds getting less exciting. Gold is showing us some signs. Oil has had quite a pullback here over the last week. And I'll touch on what my opinions are for how that may play out and how I'm looking to trade it. First things first, fear and greed. You can see it's up to 55 now. Again, this extreme greed is quote unquote showing up in bonds. I don't consider that to necessarily be a greedy thing, anything here. It's just, the key I've been talking about here is that the spread is still historically high. So it's sharply lower than recent prices, what we saw at the end of last year, but it's still historically high. This is more important to me. Look, we're starting to see more 52-week highs. That's kind of trending higher. That looks really good. And then down here, the extreme fear, quote unquote, is the 125-day moving average. So in order to get to a really, truly greedy spot, the S&P needs to distance itself from this 125-day moving average. And what are we seeing today? Really nice move in SPY that gets us above the highs of May. Really looks like it's positioned for a move up towards 280. That helps pull us above those moving averages. You can see now that the 10-day and the 20-day are above the 100-day. So things are turning here. We're seeing some good momentum out of the market that can honestly, we know it can be derailed at any time by the wrong fundamental input, something out of with tariffs or China or NAFTA or whatever. But right now, it seems like people are telling us that even with all that overhanging, it's not going to be a problem. So how do we trade it? I look for that move towards 280, that previous high. How do I play for a move towards 280 in this environment? Well, when I look at S&Ps and I look at the vol level, just a moment here, we'll pull up the implied volatility. You can see that when we're back down to the levels we were at, and just in January here, and getting close to December levels. So vol may come down another % or two, but I can get really good defined risk for a play to the upside. And with all this low, I kind of like just adding some time to my trade. So I'll look towards the end of June, something like, say, this June 25th term. If I'm looking for a move to 280, well, then I want to be long something closer to the 276s, 277s here. So I can just make a very simple trade here. I buy the 277s here for $1.10, $1.09 maybe even. And if the market runs, they're worth at least $3 if we go to 280. And if we break out through that level and make a new all-time high, and see how far on the money those things are going to be, close to $10. So there's really good leverage out of some of these out of the money options near the end of June, because of where volatility is being priced right now. It's very, very low. If we stall here near the high, it's a triple. If we blow through it, I make 10x my money. That's a really good R&R for me. The basic thesis here is that we're not going to just sit around 276. And I don't see a reason to justification for why we'd sit around 276. It's not like we need to let the moving averages catch up or anything else. The problem really comes if we wash back out down towards 264. And right now, I don't see a reason to bet for that until something comes out that starts to actually scare the market, and nothing seems to be spooking the market right now. If I go over to some of the other sectors, you can also see why this breakout's really looking good. Tech index. The Qs already above the January high and pressing the March 13th high, which was 175.21. We're really close to that. That could break out, today, tomorrow, anything like that. IWM, we know, had already broken out about 2 weeks ago, retested, and then just keeps firming here. It's really testing this high, creating a little bit of a wedge. Looks like that wants to go again as well. I'll talk more about the Qs and the IWM trades in the newsletter that's for premium subscribers. But to note, the premium subscription is free for 2 weeks if you guys want to get more information from how I'm looking at those. Now let's go to TLT. So CTLT, I was kind of talking about last week that this move was a bit much, and I thought the move back was probably towards 120. We're there now. And the trade is just kind of dying here in TLT, but it's going right back to what it was 2 weeks ago. There's no reason for us to explode lower right now. The shorts have gotten scared. The longs shouldn't necessarily make us explode higher. So we probably sit. And vol's cheap. Probably because we're probably going to sit. But for the meanwhile, since I think we're going to sit, and this vol is as low as it gets really, I can just do a simple calendar. So with stock trading, you know, TLT trading just below 120, I look at the July 120 calls versus the June 120 calls. Place for consolidation for the next 2 weeks. And in this case, I could put that on for about 73 cents. And if we sit, you know, these go to zero and the other guys decay a little bit, but there's some decent money to be made here. Just holding on to these long July 120s and watching it sit and then reevaluating, because this is sub 9 vol. It's just about as low as TLT vol gets. Okay, so that's just the simple consolidation play when you've got a situation like this where the market doesn't look like it has any reason to move. Why play for it to move? I would play for it to sit, and that's how I'm going to be looking at TLT. Let's move over to the dollar, which is chopping, and dollar yen, which has weakened some but is bouncing back today. It's back above the 10-day moving average and is pressing against the 20-day moving average, and you know the 200-day moving average it did take out but it didn't fade against. It looks to me like this obviously found some support here on that upward sloping 50-day moving average. A press back through the 10-day moving average seems like it makes us want to really press this higher. That's generally risk on. That's bad for gold. So gold has been a tough one because every time it seems like it's ready to break out higher, it fades, and every time it seems like it's ready to break out lower, something changes. But I think this time, you know, may be different. It's something that I don't want to put on with massive risk because it's been a tough trade. But looking at GLD right now, we're pressing near the lows. A takeout below that 122-ish level looks like it could wash out to 118. If I look at silver, the story looks like it's wanting to press down towards 15, maybe even 1475. If I look at GDX, that looks like it wants to press down to 21 in that case, and GDXJ would look like it wants to press down towards 30.5, maybe even a little lower, towards 30. So there's a lot of potential for movement here. I'll talk about the trade for me in this one on the premium newsletter because I want to give you guys oil instead. Since it's been the story here, you can see USO just continues to weaken. A lot of this seems to be related to concerns that OPEC is going to ramp up production, and bam, we've fixed the demand-supply imbalance. If that happens, yeah, then oil price has to go lower, and we've already gone lower now. We're getting into some consolidation area here around $13, and we have our testing and maybe taking out the 100-day moving average. But with this weakness, there has been and should be some weakness in XLE and OIH, but it's not as weak as I would have thought. You know, see, we'll start with XLE. That's down only a little bit, and OIH is down a little bit more. It's pressing the lows of the that prior consolidation area. So to me, OIH looks like it's going probably down towards 24.5. But the better R&R may be in this XLE because that's got a pretty good distance here down towards, you know, sub 70. If oil continues to weaken, I got to think that they're going to come in and hit this, especially since like XOM didn't have very good earnings last quarter. When I look over at XLE, and I got to look at the vol, of course, I can see that the vol has started to come down a little bit, especially today, down 1.6%. That is good. That helps me get my trade on, right? Deeper vol, and I can get it more leverage. 18's been a good support point, and into a weakening market, I expect this to stay at least 18 vol, maybe even a little bit firmer. So I'm looking for a move down towards, even if I just play for 70, that's $5.50 away, $6 away, probably over a little bit of time. The vol is cheap in the back end. It's a little more expensive in the front end because I think people are starting to prep for that breakdown. So why don't I just go to the July 20th? It gives me a long time. It gives me a month and a half for this break to happen. And I look at something like this. You know, that's 20 vol. That's a little bit on the firm side. So maybe I go to the 74s. And then if I want to reduce my my premium exposure a little bit, I look down here and I say, well, you know, I could sell these 71s. Yeah, they're only a quarter, but that helps reduce my exposure if the market just sits for a week before it does it. And it cleared out my July. Let me pull that back in there. Oh, I see why. I put that into the vol. My mistake here, folks. Now let's try this again. Sim complex here. All right, there we go. So if I do this as a diagonal, it's $1.17. If the market washes out, it goes to $3. If it slides down towards 70, it works really well. So a slide down, great. A crash, great. A sideways action for a couple weeks, fine. So this has a really good R&R setup for me. So I really like this, given that oil is weakening. If oil turns around, I don't like this anymore. So if somebody comes in and starts bidding back oil up, they change their tune from OPEC. Something changes on the global macro environment that makes oil back into a bull market, then maybe this changes. But for now, with oil looking weak, XLE seems like it's got some downside, and this is the way I want to look to play it: is the July 20th 74s versus the June 22nd 71s. All right. That's it for today. I talked through it all. It looks like the markets still want to firm here. And we just got to wait and see if some sort of fundamental input changes that tune. Bonds, I think, sideways. Gold, a little bit weak, and oil, a little bit weak. So commodity general weakness looks like it wants to continue, especially if the dollar continues to firm. I mentioned the premium report. The key here is you get your first 2 weeks for free. So go to tradeacademy.co/Harwood Report. You can sign up. Try the first 2 weeks for free. If you don't like it, you cancel. If you do like it, $49 a month after that. I think it's a pretty good deal for the amount of content that you get. I'll get you a Wednesday update, the newsletter that I talked about. There's a lot more information that way. You can always contact me, Keith at tradeacademy.co, or call me 312-600-8004. Happy trading, everybody.